So good evening, everyone. Before we start, I'd like to draw your attention to the disclaimer that is on screen, which I'll read for you now. All information that is provided during this seminar is for educational purposes only. The presenter is not a financial or investment advisor and is not authorised to provide recommendations on any instrument of any kind as part of this presentation. The strategies showcased are applied on hypothetical scenarios. Any instruments that are mentioned throughout are cited only for illustrative and educational purposes. The webinar is not intended to be a personal recommendation and must not be construed as advice from the presenter. Pepperstone doesn't represent that the material provided here is accurate, current or complete, and therefore shouldn't be relied upon as such. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any listeners of this content to seek their own advice. Thank you for listening. So, welcome to the first of our Masters of the Trade webinar series, a partnership between Pepperstone and the Corellian Academy. As I said, this is the first of a 13-week course where we combine real-time market education with professional trading education on strategies, processes, and analysis that our expert mentors have utilised over many years trading at top banks and hedge funds. What you see on the screen in front of you now is a trading process that we as traders developed over many years and follow on a daily basis to analyse and trade markets. It has provided us with the discipline and focus that, when followed consistently, and evaluated honestly, has made us the successful traders that we are. If I break it down, I can briefly show you what I mean for each part. Read and research is making sure you know the headlines and data that are going to impact the market today. Develop market indicators is what other financial markets should you be aware of and have in your dealing screen that will impact the trades you are currently running. We're going to show you a template later for what we as traders would have up on our Pepperstone dealing screen. Assessing the risk barometer is concerned with risk management. Defining and managing your risk in these volatile, trending or quiet markets is essential to being successful. Establishing entry and exit points is using technical analysis, and that goes hand in hand with managing your risk to establish a stop loss at the correct level. And when that's done, clearly identify the potential areas where you can look to take profit. Trading strategies is knowing what events are coming up so that you don't get caught out. Execution, as we know, is so important. It's critical to control your emotions, execute and maintain your trading discipline. Evaluating your trades afterwards is just as important, and is the honesty I mentioned earlier at the very start. Learn what you did well and repeat. Learn what you did badly and don't do again. So, today's webinar and going forward is structured in a way to offer some insight into each of these areas. Maurice Pomery, our strategy mentor, will discuss today what markets you should have on your dealing screen to help you with your trading, and then give his thoughts, his real-time education on the market right now. Richard Adcock will identify why he uses Bollinger Bands in his technical analysis as an expert in his field, and some of the technical setups he sees for stocks and currencies in the week ahead. And Roger Hawes, in the middle of those two, will run through the benefits of good risk management, and then the first of our trading strategies, which is pursuing a zero-cost strategy. Now, at the end of the presentation, you will be able to ask the mentors questions. Please put them on the chat the moment that you have them, and we'll try and get through as many as we possibly can before the end. Okay, Maurice, over to you.
Well, thanks, Chris, and good evening, everybody, and welcome to this course. We've certainly looking forward to it ourselves as well. It's another opportunity to impart some of what we've learned and understood over many years of trading in these fascinating markets. So I want to start off with some pretty basic stuff for all of you, really. And I think, you know, for me, for someone who trades slightly longer term, looks at more macro fundamental structures, I think we need to sort of prepare ourselves at the beginning of the week and have certain things in front of us every day. And I think that goes for whether you're trading short-term DAX in 10-minute charts or whether you're trading macro, more like a fund manager, if you like. I think there's some certain basics that you need to have that follow you all the way through your day and through your week. So if we look at the first thing I want to talk about is roughly some of the things I think that anybody should have to start their day and through the day to sort of give them a guide of what's coming up and what's going on. So the first thing I would be looking at when I walk into my desk early in the morning is I need to know what's happened overnight. So obviously, you know, one thing I want on my screen is the Asian stock markets, particularly if I trade stocks, obviously in Europe or whatever, but also if I'm trading foreign exchange or gold or bonds or anything, because it's a risk barometer for what happened overnight. And we can tell from what we saw from those markets roughly the way we're going to start the day. Is it going to be a quiet day? Is it going to be a busy day? Have we had a big move overnight? Do I need to prepare differently for that particular day? Obviously, through our own time zone, I'm looking, even if I trade foreign exchange, I'm looking to see what European stock markets are doing, see if there's any risk going on there. Are they all broadly moving together? Is one of them outstanding on its own? Is one outperforming? If so, why? Should I be looking if there's going to be any impact on maybe currencies or bonds on the back of that? So I'm looking for sort of indicators that can give me a heads up to what's going on in the markets. So obviously in the afternoon, we've definitely got to have the US stock markets on there. Where US stock markets go, we usually see most go, and they can be a spark of risk on their own. And for the S&P in particular, the Standard & Poor's 500, there's also the VIX index, which is a fear index. We will explain this in a future webinar, but just basically, if the VIX index starts going up, it means there's more volatility in the market, more risk, and more risk aversion, if you like. So people will be very defensive if we start seeing that VIX go up. So I like to have that on my screen, to be honest. Other risk areas, I think you've probably all been reading a great deal about gold recently, and I think, you know, it's worth having on there. It is impacted by both stocks and risk and the dollar, but also sometimes it moves on its own and sometimes can be an early mover on the day sometimes, which sometimes could be a heads up for a move somewhere else. Oil, of course, is important. We had a big crash not long ago. That spooked markets. So I think it's worth having that on your screen as well, just to keep a check on it. We had a bit of a fall yesterday. At one stage, we were down 5%. The market was getting a bit nervous. We've since bounced, and you know, it's a little calmer today, month end and quarter end today, keeping a few people on the sidelines. But G10 currency markets, obviously, even if you trade equities only, I think it's worth having a few currencies that you might want to follow. And I think against the dollar, we're looking at the euro, sterling, maybe euro sterling as well, with all that's going on with Brexit at the moment. Aussie certainly is a risk gauge for global risk, if you like. So if we have a risk on session where maybe equities and everything's flying nicely higher, then the Aussie usually performs well. So again, I'm looking to see if there's been any stress in that overnight or through the day. So again, that's a basic structure without too many bond markets and emerging markets on there. I think just for a basic fundamental start to your day, it's worth having these things on your screen every day. I think moving on from that one, you know, the other thing I do think we need to sort of add to that is, you know, obviously economic data. And I think economic data is something you should be looking at from Sunday night to plan your week all the way through the week. You should have an economic calendar on your screen. So wherever you get that from, I think it's worth having with you. So let's have a look at real-time markets right now, where we are. And I think, you know, that we've had some fascinating moves over the last few weeks, few days as well. Today we had month-end, quarter-end as well, coming on one day. And I think what we have seen recently, and one of the things that is being discussed in the markets, particularly after that fiasco of what they called a political debate in the US yesterday, we've seen the VIX index, that fear index on stocks, suggesting that we got more turmoil coming over the US election. And certainly, you know, there seems to be some doubt that particularly if Trump loses by a fine margin, he's going to contest that. And I think this is something that the markets are beginning to sort of take quite seriously now. And I think, you know, we're beginning to see that starting to get priced a little bit of nervousness over that. EU and UK COVID infections, we've got to keep an eye on these. They are rising again. Does probably mean more lockdowns. I will be discussing this a little later on in a further slide. But one of the things I wanted to pick out for you was something a Fed member, Williams, said yesterday, that it could be 3 years until a full US recovery is seen. And also, tomorrow we'll be discussing data a little later, but we've got US jobless claims tomorrow, and then the big one, non-farm claims on Friday. And I noticed that Disney has cut 28,000 jobs, Shell shedding 9,000 jobs. And I heard today that Continental possibly going to restructure and lose 30,000 jobs. So there's still a lot of cost cutting going out there. And I think we've got to, as you'll see, a constant theme of mine through these webinars is keeping an eye on unemployment and what the consumer does. Consumer confidence and consumer spending patterns are starting to show signs of some concern. And I think you'll be hearing me talk a great deal more about this as we go on. So we'll be keeping an eye on those. EU and US data is beginning to show signs of flattening out, although we're getting better data out of China. It does also seem that some of the US data is slightly better than the EU data over the last few days. So we have to ask ourselves a question, is that going to be detrimental to the EU or euro against the dollar? Possibly, who knows? We have seen some weakness recently. On the government side of things, I think it's always worth keeping an eye on what's going on there. We do have an awful lot of faith in our central banks. You know, again, I'll talk about this a little later, but certainly the central banks seem to be suggesting that they need more help from the governments with fiscal stimulus. Now, fiscal stimulus is different to monetary stimulus because it is coming from the government. They can actually put money straight into the pockets of the consumer. Monetary stimulus is really for the markets, and that's not something they can easily transfer into the pockets of the consumer, as we have seen with the massive amounts of QE that's been given by the central banks, and we've still got no inflation and not very much growth either. So monetary stimulus is a bit of a blunt tool, and I think realistically that the government's going to have to do more, and this is why we're waiting for the stimulus package to come out of the US, which they're discussing at some length tonight. On that note, the Republicans were offering 2.2 trillion. The Republicans don't want to spend anywhere near that. The discussions are ongoing between Mnuchin and Pelosi as we speak. They're trying to get a deal done before the election. If it isn't, I think that could be a negative for markets because we then have to wait until after the election, and who knows when we're going to get a result on that finally. We've also got ongoing Brexit talks at the moment, the trade talks. They go on until Friday. Keep an eye on euro sterling and sterling in particular. We have seen some moves today. There was a bit more hope that something might be coming out of that. But I think realistically, there are some red lines that neither side seems to want to cross. So we're not sure if we're there yet, but there's been a few hints that we might be getting closer to some kind of compromise. So we need to keep a very close eye into Friday on any headlines that come out of that. Certainly if there's any scheduled press conferences, you need to be looking out for that sort of thing. We have had some dissent about negative rates on the Bank of England. Ramsden was suggesting that he didn't actually see a great deal of benefit, and I have to say I concur with that. And Haldane again today was mentioning the fact that no matter how much they've discussed it, they are nowhere near actually going negative, and let's hope they don't have to. US election and the result are at the forefront of investors' minds. We're 5 weeks away, but remember, in all this, markets are forward-looking. So this is an issue for now. So we are keeping an eye. Headlines are beginning to impact markets, and I think we need to be very aware of that. So just to show you a visual of how this VIX is pricing the November the 3rd election. If you look at the bottom light blue line there, that is how the VIX was pricing the election in August. So the middle line, the pinkish line, was the VIX curve on September the 18th. And again, fairly, sort of drifting off quite steeply into the later months. But if we look at the VIX curve today, the blue line at the top, we're pricing in more risk for November the 3rd. But if you look just to the right of that, we're pricing a lot more risk after November than we were in previous months. Now that is interesting to me, which shows you the signs that the market is seeing risk after the election, suggesting a potential delay through a contested election. So I think that just highlights that quite nicely. It's the sort of thing I look at, and I think, you know, markets are beginning to start to get a little jittery about the election. And this shows you, this is an S&P chart. It's a 30-minute chart from yesterday, and this is what happened just as they got to the final parts of the debate, when there seemed to be some concern over a fluid transition. And this shows you how much market is sort of vested in this. And I think it's important to make sure that you have news screens on your screens, and you look at the news headlines when they come through. Anything to do with the election now is becoming quite an emotive subject. So that's more or less where we are right now. I'm sure a few of you, because these are forward-looking markets, we might as well start looking forward. So we've had some month-end and quarter-end rebalancing, which we're discussing in more detail in a future webinar, because this is now behind us today. But we do get nervous markets into these month-end and quarter-end periods, and that's due to sort of what asset managers have to do to rebalance their portfolios. And I'll explain that in more detail in a webinar further down the road. But down the left-hand side here, where it's got stock markets, there's a few things down there that I've listed that I think is worth you all reading through to see, you know, what sort of things I'm looking at, to see where some potential risks are, things I need to make note of. I still think, you know, investors are still very keen on further stimulus from central banks. That's what got equity markets to these dizzy heights. And to be honest, what I'm hearing from the central banks is that they're not prepared to do a great deal more until you know, they see any further need for it. And at the moment, that doesn't seem to be there, apart from possibly at the ECB, who have got a deflation problem to fight. So it looks to me like the Fed is on hold for a little while. Possibly the Bank of England. I think we may see more from them if we get a no deal exit. But if we don't, I think they're probably done for a while as well. Keep an eye on the initial jobless claims tomorrow. Data comes out. It has impacted markets nearly every week it's come out. It's high frequency data. I like it. I think it gives a heads up. And we have very, very important non-farm payrolls data on Friday. And this will be a feeder into some of that. So I think what we need to ask ourselves is if data is now showing the recent bounce for the global economy, if it's continuing or whether it's flattening out. And whilst again, China seems to be moving a little bit further away since they've sort of controlled the virus. I think these continued lockdowns in Europe and in the UK could be damaging. Whether the US needs to go down this route again, they could be lagging. The mortality rates are down, but they are beginning to rise. And once that happens, governments feel duty bound to do something. So be careful of that. This rise that we're seeing at the moment could suggest a bit of a bleak winter ahead for most of us. I think also EU inflation is becoming a topic. The ECB's mandate quite clearly is to fight low inflation, get inflation back close to but not above 2%. Now, they have literally failed on that for years. Not just Lagarde, but Draghi before him. And realistically, there is a problem here that everything they seem to throw at it, as we've seen with the Bank of Japan, does not seem to have any impact. So it does make you wonder what comes next from the EU, from the ECB. Maybe they'll try more of the same, but unfortunately, I'm not sure that's going to work. So we're looking out to see if they come up with anything original to do. Otherwise, they're headed down the same path as Bank of Japan, where they have no inflation and no growth. Interesting on that side of things, there was a recent paper that came out just this week from the San Francisco Fed suggesting negative rates depress bank earnings. If you look at what's been going on with UK bank earnings and particularly EU banks on their stock markets, then you can see that they've got a point. The banks have been drivers of the market down, underperformance in the UK and underperformance in the EU, and they still remain rather vulnerable. So looking ahead at currency markets, for those that are more interested in that, the month-end and quarterly balancing didn't really see any sort of stress in what we call repo markets or any massive demand for dollars. We've had a bit of a choppy session today, which is classic at this time of the month. But I think, you know, we have to ask ourselves, you know, what's going to drive the dollar from here? And at the moment, it looks like it's probably going to be whether we have a risk-off structure or a risk on structure. So the general rule at the moment is if we see equities start to fall quite steeply, we actually see a dollar higher in that environment. It's known as risk off. That's risk being taken off, looking for safety. The biggest safe haven out there in the world at the moment is the US bond market and the dollar. And we've certainly seen evidence of that over the last 6 months. So I think we need to keep an eye on what equities do from here. They are quite high again. They've had a very good bounce. But there's a lot of risk into year end, to be honest. So we need to be careful of that. Euro, you know, we are beginning to underperform. I think some of the bulls are getting rather disappointed here. And I think there's a danger that, you know, if the ECB does have to do more, we may see the euro down again. It's not a view I hold particularly strongly at the moment. I think the dollar is a very large component of that. But one thing we are seeing is some underperformance of euro against sterling, as there's some hope that some of the Brexit talk negotiations start suggesting something of a compromise. So the thing with the Brexit deal is Boris Johnson has more or less put an October the 15th date on this, because if there is any sort of turmoil, he believes to prepare the country for coming out at the end of January or beginning of January, that they need time. So we are very close to that date now. So these talks this week, I think, are really far more important than any other they've had. So keep an eye and see what the press conferences bring into the end of the week. Could be a big week for sterling, and I think you know, there's a chance that we could see some pretty wild swings in that. The RBA, which is the Australian central bank, has made some remarks towards further rate cuts, and we've seen the Aussie underperform a little bit. But again, remember, the Aussie will actually move with risk on and risk off. It's very much a global trade currency, if you like. So as we see sort of global risk moves, or if we see something very strong coming out of China, Australia, sometimes the Aussie will sometimes do well on the back of strong Chinese data. They are a massive exporter to China, one of their largest, and basically China has sort of kept them bunkered away from all the crises in the past through that growth. But now there's it's not quite the same. So Aussie is beginning to follow risk. So that 70 cent level, we've hit it just above it a couple of times recently and bounced. Just be careful if we start getting back towards that level. And again, it may depend on how the risk markets are sort of producing any signals. So risk is a big key in foreign exchange at the moment. And as I said earlier, we need to be aware of what's coming up. So we actually look at this on a daily basis, and looking forward to tomorrow, I would already be planning my day tonight, and I would have this up on my screen looking at what's coming out. So the big one for me, the 2 stars tomorrow, is initial jobless claims. As I've said, that's how many jobless people are claiming benefits. It comes out at 12:30 GMT, that's 1:30 London time, and it can move markets. Particularly when it's so close to tomorrow's 3-star event, there you can see on Friday rather, is non-farm payrolls at again 1:30 London time, 12:30 GMT. That's a big number, always moves the markets. And also anything to do with the consumer or retail sales or unemployment is data I try and highlight. So, you know, we're going to talk about how we prepare for these big data events in another webinar, but I think it's worth having them on there. It is not acceptable to lose money on a position where the information was in a diary that something was going to come out. Be aware of the events. The other thing I think we need to be aware of is how we deal with the psychology and the risk management of trading. And with his experience in the markets for so long, there's no one better than Roger Horse to talk you through that next. Roger?
Thanks very much, Mo, and a good start on basically us trying to offer how we set ourselves up for trading. And you'll hear us mention many times throughout the weeks about process and discipline, and you know, it's a very key part of how we felt we've been successful over the years. I just want to look at, you know, some of the key aims for me before we move into the first part of the presentation. You know, over the weeks, really, I'm going to be looking at how we can manage our capital better, and by that, I'm going to be looking at stop loss management, take profit levels, risk reward, allocation of capital, leverage, all those things that for me help stock traders become very, very one-dimensional in the way they approach the markets. And by adding some flexibility to that trading, and that can be your capital allocation, it can be duration of trade, it can be different markets that you look at. And we're going to try and do that as well by showcasing some different strategies that we've certainly used in the past. And I'm a great one for hopefully helping you visualize the opportunities that are out in the market. And the final key thing for me is how we manage ourselves throughout this process, throughout this experience of trading. I'm not a psychologist. You won't get any psychobabble from me. Everything you'll hear from me is my other people around the globe, in what can be very, very hectic markets. So the first thing we are going to look at is what we would classify as a risk barometer. And really, this is absolutely fundamental in your trading. It happens right at the very outset. And as I say, it will, if you use this properly, it will stop you being a very one-dimensional trader. It will stop you getting into areas of pressure and stress when you shouldn't have even been in that situation. So it's a very, very simple concept, and something hopefully here you can just keep that visualization in your mind. And the simple fact that the amount of capital that you put into the market, whether that be in units, lots, margin, etc., has to reflect your conviction in the marketplace, your conviction to your idea, your familiarity even with the markets. And actually, there's a few other things that we'll see over the next few weeks in terms of when we're looking at our entry levels, where the market is at the time, etc., that will also affect the capital that you allocate. And we will be going through a couple of those tonight. When markets are pretty skittish, as we have been finding over the last 6 months, you're going to get some of these, these moves that can absolutely kill traders in their trade ideas. Every trader hates a straight line move. And what we see here is just a day's trading where you get some pretty nasty moves. And the simple thing here is, once you understand you're in these relatively illiquid markets, you need to be tailoring your risk accordingly. So in these instances, you should be cutting back on your risk, because the main idea here is to be able to survive and stay in the position that you want and try and experience the move when it eventually comes. There's nothing worse than actually diving in too deep into a marketplace. You get one of these bad straight line moves that will happen, it knocks you out, and then you see the market go higher. And some of the ways of controlling this is recognizing that we're in illiquid times and tailoring your risk accordingly. It doesn't mean to say you can't make decent profits, because clearly with this risk and dangers also come opportunities when the market starts extending and moving itself quickly in your direction. And in those instances, that's where we're going to talk a little bit later about risk reward and making sure your ability and your limits to taking losses is reflected in an extended move in your favor to take your profits. So one thing here, and again, just take this as a concept, we're not looking at these numbers specifically. If you were sitting in this situation where you recognize we're in volatile markets, and particularly where news headlines can have an exaggerated effect on the marketplace, you can actually have the right idea and get taken out. So the key thing for us here is making sure we recognize where we don't like moves, And actually that in the end governs the amount of capital that you can allocate to a trade. So the simple concept here that we have is where we are looking to go into a trade. And if we move the slide on a little bit, Chris, we want to be able to share in this upside move. But what we're actually going to move on to is the simple fact of entering into a trade, and we're going to go into this trade. On the left-hand side, we just picked kind of mid-range there at 123.75. We've done a little bit of reading. We like the idea that the marketplace can go up. And so we're going in at 123.75. Now, just take, for example, we've got this situation where we like the idea, and we think there at 122.75 is our stop loss level. That's 100 pips away. Now, for example, if we were used to trading in 20 lots, 20 units, 100 pips in this instance would be £2,000. But as I've said before, you know, some people don't have that capacity to run losses that far. Some people actually, you know, put their own limitations, or they could be system limitations. And let's say, for example, £1,000 was a maximum loss you wanted to take on the trade. Here's the key thing: do not move your stop loss up, in this instance to 123.25, because that effectively means you've lost £1,000 and you're out. The smart thing to do is to always make sure your stop loss is in the right place. So what you do here is keep your stop loss at 122.75. You reduce your trade size by half, and then when you do, or if you get stopped out, you've still only lost your £1,000. You've done everything correctly. Everybody takes a hit from time to time, and you move on to your next trade. But the important message here is make sure your stop loss is in the right place. And if that means reducing your capital, then so be it. Do not move your stop to basically limit your loss. And then clearly, as we see here, the market would bounce up. Fortuitously, we would have stayed in this trade, and we get up to those levels up there at 124.75. 74 was the high, and that's at that point that we can look at extended profits. We've protected ourselves on the downside for 100 points. We're going to talk in future webinars about risk reward, and in this instance, if you were to try and take profit up there, you'd have a one-to-one risk reward. For me, they're okay from time to time, but over a longer period of time, we're always going to be looking to get that risk reward up towards the 1.5, 2, 3. There's no great formula. Sometimes it changes throughout the life cycle of a trade, but we want to get to that point where we can start looking at extended profits, whereby over a big group of trades, we're looking to make more than we actually ever put our stop loss out to lose. So that's the end of my first session. We mentioned, or Chris mentioned at the very start, part of our process, a very important part of our process, is actually looking at the technical analysis that sits behind all of these markets, multifaceted. And you know, Richard Adcock is going to start these sessions and introduce many of these facets, and not a better man to walk you through it. So I hand you back to Richard.
Great. Thanks very much, Roger. Good evening, everybody, and it's great to be here. I've been a technical analyst for about 35 years now in various sort of markets. And over that time, I've sort of built up a knowledge of the subject. And believe me, I could speak for a week and only really scratch the surface of the subject. So these webinars sort of are restrictive to a certain extent, but they're good in that what they allow me to do is to actually concentrate on the particular techniques, the particular indicators that I, over the years, have found very useful and continue to use on a day-to-day basis within my own particular analysis. So over the course of these webinars, what I'll be doing is sort of breaking it down into various areas of the subject, looking at the indicators that I find useful and showing you how they can be adapted, how you can use them to actually establish a trading technique and to look to use them on a consistent basis and hopefully from a profitable basis. So basically, my approach to technical analysis is very simple. And what I would sort of suggest to anybody that's using technical analysis is to keep everything very, very simple, not to overcomplicate things. To firstly use what you know and what you trust. Now, what I mean by that is to actually get to know the various indicators that you're following, that you find useful, that suit your own particular trading techniques, because these webinars are not designed necessarily to teach you how to trade or how to become a technical analyst, but to help you find your own particular approach to trading markets so that you can be profitable and consistent within your approach. So I tend not to overcomplicate things. So I would tend to only use 3 or 4 indicators on any chart, on any market that I follow. And they are basically concentrated around what I think are the 3 most important areas within technical analysis: trending, momentum, and sentiment. Trending for the direction, momentum for the speed, and sentiment effectively to tell you when those changes in direction are taking place and when you need to be adjusting your risk management and actually looking to maybe even increase risk or reduce risk to suit the signals that are developing. Also, even if you're a very short-term 5-minute trader, what I would suggest is that you look at charts across all time frames. So hourly, 4-hourly, daily, weekly, even if you're a short-term trading perspective, because basically it allows you to see obviously the bigger picture, but also to highlight important levels and signals that may not be materializing within the shorter term time frame. So it's very important to expand your time horizon, even if you're very short term, to take in all aspects, to see some things that you might be missing when you're blinkered into the shorter term perspective. The last and most important is to keep things consistent and disciplined. Basically, don't go flitting from one indicator to another because this time this indicator didn't work, but that one did. Try and build up a broad breadth of knowledge of types of indicators for the types of signals that you're looking for and stick with them. Don't keep switching backwards and forwards because it's very important, and I think you'll find the benefit of keeping a very sort of consistent approach to the analysis that you're actually carrying out from a technical perspective. Okay, so the first indicator that I want to look at is basically one that I find extremely useful in establishing trending conditions within the market, but more importantly, helping me stay with the trend. Because when you have an aggressive trending condition, be it to the up or to the downside, that's obviously where the greatest potential is evident from a trading perspective. And Bollinger Bands allow us to gauge that aggressive trending nature of the market and allowing us to sort of concentrate on areas that we need to be holding positions, even increasing risk of positions, looking for this acceleration of trends to continue. So basically, a Bollinger Band is a trending indicator. It uses a 20-period moving average. Most of the examples that I'll highlight are daily charts. So we're looking at the 20-day moving average, but if we were looking at it on an hourly basis, that'll be a 20-hour moving average. The bands above and below the moving average are adjusted for 2 standard deviations. Now, don't worry if you don't understand the concept of standard deviations. Basically, what it allows you to do is to study price volatility. So if the bands start to widen, it shows increasing volatility within that trend. And if bands are contracting, then volatility is decreasing, and we have the signal and risk of a consolidation developing. So the direction of the moving average gives us the trend bias. So if the moving average is rising, we gauge that we're in an uptrend. If the bands start to widen, then we're in a positive trend and the volatility is increasing. And in that particular setup, the chances are that the market will continue to move within the direction of that trend. So effectively, we have confirmation of trend, confirmation of increasing volatility, and risks of that market move extending further than the majority of people are thinking and anticipating at that particular time. So let's have a look at a chart of Bollinger Bands and the S&P index. Now this is the S&P at the end of last year in the run up to the February sell-off. And Bollinger Bands were very useful in allowing us to gauge how significant the volatility was at that particular time within the market. So the first reference with Bollinger Bands is the direction of the moving average. So during December, early January through to early February and into mid-February, the mid-average, the 20-day moving average in this example, was rising. So we were trading in a more positive condition. But you'll see that the bands themselves are relatively parallel. So what this actually reflects is no significant increase in volatility. So in other words, in that type of setup, we would look for the market to trade either between the support of the moving average and the resistance of the upper band, or if in this case, if the mid-average starts to give way, we would look for support to develop at lower bands and then the market to continue to move higher within its more positive themes. So steady volatility within an uptrend effectively gives you a trending channel ranging between the resistance of the upper band and support of the lower band, with the moving average actually also acting as an intermediate support point. However, during the sell-off in mid to late February, we started to see an important change within Bollinger Bands. We sold off and closed below the moving average, and we touched the lower band within one session. Now, as we see within this example, that's not necessarily a significant development. We've seen that previously, so the market could still be trading in a positive trend within the uptrend channel. But as the market started to sell off, we started to see the bands widen. And what that reflected was increasing price volatility. And when we see increasing volatility, the risk is that the market is going to continue to move within the direction of that trend to give us a much more significant signal within the Bollinger Band setup. So as we started to tag the lower band, the moving average turned lower to suggest that we're now trading within a downtrend, and the band started to widen. And within that setup, the risk is that we will continue that ongoing trend as long as volatility continues to increase and the downtrend reflected by the moving average stays in place. So throughout this time, as the bands were widening, we continue to see evidence of the market continuing to trade within a more negative trend throughout that period of time. So as the market then recovered and the band started to contract, so volatility started to decrease to highlight a consolidation risk, we then saw the S&P index back towards the resistance of the mid-average. And you can see that we held around that point as the market attempted to push higher, and we turned lower from it for a couple of sessions. So effectively, we would be asking what is needed at that particular point. Well, for an upside bias, we'd need to see a break above the moving average and for it to turn higher. The bands then to start to widen to highlight increasing positive volatility and moves towards the upper limits of the band. So in other words, we're tagging the upper band, volatility is increasing, and the moving average is rising. So that's for an upside bias. For a downside bias, the moving average would continue to fall, reflecting a downtrend. Price breaks under the recent lows, and the bands start to widen again. So actually what we saw happen after this consolidation was the market break up and close above the moving average, prices rally, the moving average starts to turn up, and then the band starts to widen, and then the volatility settles down and we see parallel bands again, and a trend channel effectively developed. And obviously the rest is history in terms of the market and the S&P continuing to move higher and posting new highs. So the overall setup of Bollinger Bands is very important to reflect how we're expecting the market to trade and where we're starting to see more significant signals developing. So the average rising gives us an uptrend, bands widening, volatility increasing within that uptrend, moves to the upper bands, suggest an upside bias. So the Bollinger Bands gives us a very good feel for how the market's trading from a trending perspective, but also from a volatility perspective. And if you see these aggressive setups, be it to an up or to a downtrend, then the risk is that the market will continue to trade within that trending condition for a prolonged period of time. Okay, so that's Bollinger Bands. What I want to do now is just flip across, if I can please, Chris, to the live markets on the Pepperstone charting system, and we can see the setups that we currently have within the overall structure for the various markets as they stand at the moment. So I'm just going to flip this to a daily chart, and we can see that the S&P index with Bollinger Bands, the bands themselves are contracting quite sharply, so volatility is decreasing. But interestingly, each time the market's rallied within this setup, we've found resistance from the mid-average. We've tested that point today fairly aggressively, but we're still trading below it. So we would need to see a close above this falling moving average, and then the average start to turn higher to suggest that this correction phase is over. So at this stage, it's really just a monitoring of the current setup within the overall structure, and the risk that this overall condition for equity markets is that we're still looking at the risk of the correction while we're below this mid-average. So for me as a technical analyst, would be focusing on that point, looking for the potential of either a break to the upside to trigger a more extended recovery, or a resumption of negative themes and then bands starting to widen again to suggest more bearish developments developing again. In terms of the DAX, we can see that it's been a very choppy sideways trading range. Now for me, it's still this last correction low that we posted at 12.21 on the 30th of July. Basically is the important support point to the downside. If we start to see that level give way, this would be a rolling over type process of a negative shift in sentiment and the risk of a more extended sell-off developing again. But we look at Bollinger Bands and the average has turned down, so we're trading in a more negative trend, and we've failed to break above the overall resistance of this trending condition. So while we don't have increasing volatilities yet, the overall risk is still towards lower levels against this setup, and technicals would suggest retests of these lows again over coming sessions. In the FX markets, we're now looking at the euro dollar on a daily basis, and again, Bollinger Bands are highlighting a more negative trending condition. Now, significantly for me, last week tended to highlight dollar strengthening conditions developing. Now, at the beginning of this week, as I did my reading research over the weekend, having seen what was an aggressive move lower or move higher for the dollar last week, move lower in euro dollar, the risks were for some sort of reaction to develop as a reaction to overextended downside conditions to begin this week. So I was open to a recovery, but the overall risk is still towards this being a downtrend. The mid-average is falling. And while we're below that mid-average, then the overall risk is still skewed towards lower levels, an extension of this negative pattern of lower highs, lower lows, and the risk for extensions of test of lower support points over coming sessions. In terms of sterling US dollar, this is actually a 4-hour chart of cable. And I just wanted to highlight the fact because we've started to see more positive themes developing after this sideways activity where the market volatility was decreasing. We then started to see prices tagging the upper band as the average turned higher. to suggest a more positive trending condition. And the setback today actually found support at the mid-average. So it's very important to be aware of the trending condition of the market. So in other words, looking at not only Bollinger Bands, but we'll look at other indicators over future webinars, but looking at the mid-average to give us a feel for the trending condition. And for cable, it was still towards the upside. The risk was that this could be act as a support point, and any upside could resume more recovery themes. So the overall risk was still more constructive and potential for a move towards higher levels over the course of coming hours and coming sessions. So, while we're above this mid-average, as a technical analyst, I would look at that as being an important support point and monitor that on a day-to-day basis within an intraday perspective, looking at that as being a support point. Now, this is a daily chart of the Aussie US dollar. Again, for me, last week's decline in Aussie versus the US dollar, much US dollar strength, reflected a more important sentiment change. We started to see bands widening, the mid-average has fallen. We have seen a recovery this week, but again, you can see that the mid-average is still falling and the overall structure is still where we've broken the last correction low. So any upside still technically looks vulnerable, with risk skewed towards a more extended sell-off while we're below this mid-average. And then finally, just looking at the Euro Aussie chart, because obviously, the dollar may well be times be a slightly confusing backdrop, so we would look elsewhere within the overall structure. Well, Euro Aussie effectively has been back towards upper limits of this sideways trading range. And even though the mid-average has risen, this is why it's important to monitor price activity and important support and resistance levels to highlight points that we need to see broken to trigger a more extended advance. We've failed at these upper limits of this range, and the market has started to sell off. We're back to the mid-average of Bollinger Bands. So again, that could be a support focus. If that starts to give way, then technicals would suggest retest to the lower limits of the range, and then obviously the importance if that starts to give way. But effectively, Euro Aussie is still a sideways trading range. Bollinger Bands are helping us trigger any sort of acceleration to the downside if we start to break that mid-average, and tend to suggest a more extended decline and test of lower levels. So Chris, if we can just flip back to the main presentation, I think the overall structure is one where we're still looking by using Bollinger Bands to highlight the trending condition of the market. But importantly, if you see an aggressive trend developing, Bollinger Bands highlighting that increasing volatility within that trend can give you some very strong and reliable signals for that trend continuing and to accelerate in a much more aggressive way than perhaps has previously been seen or would normally be seen. So the overall risk from Bollinger Bands is that they can tell you when the market is aggressive, when you need to be active within the market, because those aggressive trends are important to monitor and give you the best potential to take advantage of price movement, and the overall risk of where we need to see price corrections hold to continue that ongoing positive trend. So hopefully Bollinger Bands will give you that insight and allow you to look at the overall structure of price action. So that's the technical section for this week. I'm just going to hand back to Roger, who's going to look at our first trading strategy, which is pursuing a zero cost strategy. Thanks very much, Roger.
Thanks, Richard. And I think you're all going to enjoy those sessions over the next few weeks, particularly the live updates. We're going to move into the first of some of the strategies that we want to put forward to you. But just before I do that, and going back to our risk barometer and that capital allocation, just one very strong message I would offer you is you can be you can be short, you can be long, but you can also be square. Square is also a very, very valid position. And we'll go into the reasons why I think next week, but please don't feel you need to have risk in the market all the time. Don't go chasing the market. There are times when having no position at all and stepping away can be very, very valuable for many, many reasons. So yeah, a strong message from me on that one, and we can dig deeper into that over the next few weeks. So we're just going to go into looking at pursuing a zero cost strategy, and I like this because it brings a bit of versatility into your trading. As you may be aware, I've mentioned one-dimensional trading before, and I think that's a habit that people need to get out of to make sure that you know, they don't burn out quickly for a start, and you know, they're not, well, and they're still trading successfully in the years to come. So we're going to just look at this scenario where you know, we've done a little bit of read and research, and we've looked at our calendar, and we've got this set of data coming out. And again, please just look at the concepts of what we're doing here. And yeah, we've decided we want to sell ahead of this PMI data. We think it's going to be weak, and you know, we decide to sell shortly before the release 10 units, and 10 units in this instance is my maximum conviction. And the reason I can have maximum conviction is because I'm trading over a specific event. It's going to be a very, very binary trade for me, and I can have a very, very tight stop loss against it. And so in this instance, it's not so much that I've done loads of read and research and, you know, this is my best trade of the year. One of the drivers that helps me put maximum capital allocation into the trade is the simple fact that I can apply a very tight stop loss to this. So I sell my 10 units, I put my stop loss in, and again, as soon as you have risk in the market, the first thing you should be looking at is where you protect yourself. These markets move very, very quickly. And if you haven't thought about your stop loss and you haven't put a stop loss in the system and you're running a bit naked in terms of protection, then you need to be there in the marketplace protecting yourself as soon as it starts going wrong at the levels that you don't like. In this instance, a very, very simple stop loss for the full 10 units at 110.35, and that's above the high of the day. So that's our protection. It's binary. If the numbers come out positive, we're going to lose money. If they come out negative, we've clearly got a chance of making money. Now, as that data comes out, and it comes out in our favor, we obviously have the immediate choice of buying those units back. No one is going to stop anybody making a quick smash and grab. In this instance, we've sold our 10 units, we buy them back at 38 ticks lower, we made a nice profit. Nobody goes poor by taking profit. We got the piece of data that we expected, it came down, and we decided at that level down there at 77, we'd taken profit. We spoke about risk reward here. It's good risk reward. We were prepared to risk 20 to make 38. That 38, where we took that profit, it would have been in our mindset, some idea where we thought the market might move down to from previous moves, from some of the charts that Richard speaks about. And we've taken a nice profit. It's a good structured trade. This is much, much different to just opening up your trading platform and thinking, oh, this goes up, and just jumping on that trade. This has structure behind it, and that's the type of trade that, you know, we want people to really start looking at, because this is how you really define yourself as traders, in making sure your risk rewards are correct, making sure your stop losses, etc., are all valid in your process. But now we want to quickly look at just another way of trading exactly the same scenario. In this instance, we want to potentially give ourselves a little bit more skin in the game, as the market potentially could move in our favor. So exactly the same scenario, we're selling ahead of the data, 110.15, 10 units, maximum conviction because we got a tight stop. And what we want to aim at is getting our stop loss above, our position of entry above where our stop loss is. And so as the tape plays out, the market comes down, we get the data release, thank you very much, but as we come down, we only buy 3 million units down at that 77 level. We've made that decision, we bought the 3 units, and so we're only 7 units short, and our average has moved up to 110.30 because we've clearly taken profit of 3 units, 3/10 of our risk. As that gets soaked into our average, we're short at 110.30, and we got a stop loss at 110.35. Now, clearly also make sure you adjust your stop loss if the system doesn't do it for you, so that you now only had 7 million units in it. So we've nearly achieved a zero-sum trade. What I like about this is that we're still short. We've got the weak data, and we get a chance to start taking a look at the marketplace. Now, it does retrace back up, as you see, to our entry level, to the level where the market sold off from the data release. Now, for me, all of that is information. I like looking at that. I like the fact that it rejected that line. And so we come back down again, and what do? We take advantage of the sell-off. We see the previous low at the tail of that candlestick on the left. We find that as a support line, and we decide to buy 2 more units back at 109.65. Remembering we sold at 110.35, we're now buying back at 109.65, some of our risk. We put that into our average, and we're now 5 units short at 110.56. Hey, what? That sits above our stop loss. There's no reason to change our stop loss here because it's still above the high of the day. It's still not been touched since the soft data came out. So we stick our stop loss at 110.35. It remains the same. We reduce it to 5 million units. If the market seriously jumps from here, we get stopped out at 110.35. We actually end up making 21 ticks on our 5 million units. So actually, not only is it a zero cost trade, if we get stopped out, we make money on that trade. So by adding a bit of structure, by being a little bit more patient and letting the market come to us a little bit, we've managed to put ourselves into a nice trade. And what I love about this is that every tick that has traded from the piece of data to where we bought that 2 million units at 109.65 is information. The next ticks that come after that, we see an extension of the down move, and remember, we're still short. We can share in that move further down. So we're still invested in the market, but we're still nicely protected in a way that won't cost us money. So just an example there of some of the trades we can look into get into, being a bit more flexible, being a bit more patient, and trying to trade slightly longer term. And hopefully you enjoy some more over the next few weeks. So I'll hand you back to Chris for some questions.
So thank you. Sorry, I've gone too far. Thank you, Roger. Thank you, Maurice. Thank you, Richard. So I'll go straight into the questions because they started coming in thick and fast at the very start. So Maurice, one for you. What happens when all of this stimulus that you were talking about earlier on in the presentation comes to an end? I know that's one of your big topics for the future.
Yeah, it's a very good question, but it's a very big question. It would take a long time to explain it all, but it depends on why they stop. You know, if they decide that they suddenly just can't afford it anymore, or that it's creating the wrong impact, then we could see some serious market moves, particularly as all this stimulus is what has taken the stock markets to these dizzy heights. So if they do stop it suddenly, then obviously it's a massive issue, but I don't see them ever doing that. I think they'll do this piecemeal and give us plenty of communication because they know what would happen if they just withdrew it. It's like taking the drugs away from a patient, really.
Oh, thank you, Maurice. You've just had a couple of sounds. You come across a little bit like a robot there. Is it possible you could just dial out and dial back in again? Because there are a few more questions for you, and I'll go on to ones for Richard and for Roger, if that's okay.
Okay.
Richard, I mean, you might be able to answer this. Is it possible to gauge fundamentals through technical analysis?
That's a very interesting question. I do know people that run technical analysis on fundamental numbers. So basically, they'll plot, for instance, non-farm payroll or other data points, and they'll look at trends that are developing within the data. Personally, to be perfectly honest, I haven't really found any benefit of that. Yes, you can see an uptrend, and you know, I'm a technical analyst and I look for chart patterns in everything, but I don't really see that it offers necessarily that much more of an advantage running technicals on the fundamental data. It'd be interesting to hear what Mo has to say when he comes back, but you know, I don't really think it's a great benefit, to be perfectly honest. It's more the price action to the data once it comes out that you should be interested in.
All right, brilliant. Morris, I know you're back on. Have you any thoughts on that?
I missed part of that, I'm afraid, whilst I was logging back in.
So the question was, can you like using technical analysis, can you actually, does that give you some insight into the fundamentals?
Well, to be honest, I think they run hand in hand. I mean, I trade a slightly longer term structure working on basic fundamentals, but I try and time my trades with looking at technical analysis. I mean, with some very bright people I've worked with in the past, they've had some great ideas, but didn't actually make any money because they couldn't actually time the market, and timing is everything in these markets, of course. So I think you use them hand in hand if you want to sort of look at a longer term trading strategy.
All right, thank you very much. Now, you talked a lot about a big day today, which was month end and quarter end. You know, I know we're going to talk about this in other webinars, and we're going to give a real good run through of what this actually is. But could you give us a brief description of what that means?
Yeah, I mean, basically what it is, the major asset managers or pension funds have a weighted portfolio. Let's say it's 60-40 equities and bonds in their portfolio, among a few other smaller items like gold maybe. But basically during the month, there may be a very large move on equities and not such a large move on bonds. And so at the end of the month, they're in a situation where they need to rebalance their books back to that 60-40 strategy. And so therefore you see a need to either sell a lot of stocks or buy bonds or buy dollars or whatever, because don't forget, when these guys trade global equities, they have cross-border currencies to hedge as well. So sometimes at the end of the month or end of the quarter, you get a move on foreign exchange, the dollar, you'll get a move on equities and sometimes bonds. So it's a rebalancing of their portfolios, that the structure they try and end up with every month.
All right, brilliant. Thanks for that. One for you, Roger. Sorry, Richard. What indicators can we look at to show if a move is running out of steam? If somebody tends to get fixated on their winning trades, on levels, and then the winning trades maybe turn into losing trades. Have you any insight on that?
Yeah, that's an excellent question. I mean, and it's something that a lot of people, and the majority of people, do experience and find very difficult. In terms of technicals, looking at the Bollinger Bands that we looked at earlier, if you've been trading in an aggressive trend, as we had in that example with the S&P selling off to the downside, once you start to see bands beginning to contract, then that's an indication of consolidation. The risk of that you're going to see a reaction to the overall structure of the trending condition of the market. So in other words, the whole advance or sell-off is based on the increasing volatility that maintains that trend. So if it suddenly starts to ease off and the bands contract, then that's a reasonable and pretty reliable signal of sort of consolidation and the potential of perhaps you need to sort of reduce risk within that type of structure. There are other indicators as well, like momentum indicators, which we'll look into in future webinars. They all sort of highlight the speed of market moves. So if you suddenly start to see momentum slowing within the upside or downside of a trend, then that could be an indication for consolidation, or indeed just price action itself and looking at sentiment. And when we look at sort of one-day type candle patterns or one-period candle patterns, we can see the type of price action that suggests consolidation as well. So there are a number of ways of to approach that problem, and each offer opportunities to sort of reduce risk within an ongoing trend before or just as the consolidation starts to take place.
All right, thank you very much. Roger, one for you potentially. Somebody was asking, is there a way to reduce, the cost of the spreads that maybe they're paying? Would you suggest maybe bids and offers and things like that? I know we're going to do some stuff about staggering your entry orders into the system as well. Have you any thoughts on that?
Yeah, I think a couple of things I would say on spreads is they're generally there for a reason. They've certainly been driven down over the years as the electronic systems have started building spreads as opposed to humans. If a market is moving strongly and quickly, that is one of the reasons why there's a bit of a spread. And if a spread widens, you should not be frightened to pay that spread away, because it's actually telling you something is probably going on. As long as you're on a system that you're comfortable with, and the spreads are generally relative to other systems, then a slight widening of a spread is reflective of liquidity, and I wouldn't say to people don't trade because you think a spread is wide, because you could be missing one of the best trades. So I don't think it's something you should be fearful of. You should understand spreads and understand what they're actually trying to tell you, but don't be frightened of them, because they provide opportunity. You just got to be a little bit positive and courageous on them.
All right, thank you very much.
The other thing you mentioned, and it's something we'll go through, is you don't always have to pay a spread away, and we talk about smart entry and exit levels, smart execution. Sometimes it comes down to this, being a little bit more patient, doing a bit of research, and we can certainly help people through that over the next few weeks.
All right, thanks very much. Somebody was asking, Richard, is ADX and Bollinger a bit the same?
Yeah, they are similar, but I mean the Bollinger Bands puts the extra concept of volatility in that, and using the two together, the ADX is basically another trending indicator. Basically using the two together, I've found that the Bollinger Band tends to give slightly earlier signals and slightly more reliable signals, and to keep you within a more aggressive trending condition, to highlight when the market acceleration phase is taking place, and hopefully to be able to take full advantage of that. The ADX can be quite slow in generating those types of signals. You can adjust the time frame of the indicator itself, but then that gives you much more volatile and choppy signals, which sort of negates the validity of the signals themselves. So in my experience, I've always found that Bollinger Bands probably are more reliable to use than the ADX.
All right, thank you. While I've got you on, Bollinger Bands, do they also work the same way for foreign exchange pairs?
Yeah, absolutely. It doesn't really matter what you look at. I mean, I look at FX, commodities, equity markets, rates markets, you name it, and I use Bollinger Bands on all of them. It doesn't matter what market, what time frame. The theory is still the same in terms of generating this increase in volatility and the acceleration phases within those trends. So yeah, it can be used across a broad cross section of markets.
And time frames, is there a particular one that's most effective? I know you like your 4 hourly, but what are your thoughts on that?
Yeah, I mean, it comes very much down to your own particular trading approach. I would use them on any sort of time frame. personally, I find 4-hourly charts gives me a slightly better feel for how the volatility and trending condition of the market is developing. That gets slightly reduced the shorter time frame you go through, but you know, again, you're still, all you're doing is studying price and price action, and you're taking into account that price action. So if you see a trend forming in price and increasing volatility within that trend, no matter whether it's a 1-minute chart or an hourly chart or a daily chart, you're still looking at the same price action developing within that trend, just on a shorter time frame. So again, it can be used pretty much across all time frames.
Okay. One for maybe for you, Maurice, because what are your thoughts on gold from here? Obviously, it's had a big move up since March, then it's topped out a little bit, and you know, struggling to regain the 2000 area. What are your thoughts at the minute?
I don't really have a strong view on gold here. I think the problem is it's being pulled and pushed around by a few things at the moment. Obviously, gold is quite sensitive to what's going on with equities. It's not a great hedge against equities because when we get steep sell-offs, we see gold go down as well. So that's tough to hold if you haven't got a view on equities. Also, it's slightly negatively correlated with the dollar. So as the dollar goes up, you'll often see gold struggle to go up and usually go down. So it's got a lot of factors working against it. And I think whilst we had, you know, when it was down at 1600 or, you know, 1700, there were some fundamental reasons for it to go higher, particularly with the Fed so active in the markets, debasing the dollar as such. But I think that's sort of slightly come off the boil. So I think we're at a bit of a crossroads here. I don't have a clear view on gold here because I think there's some real risks to this rally. But there again, you know, if the Fed steps back in and starts doing more and the central banks will start going again, then I think gold will go up. But I think they're on hold, and so therefore I think gold's on hold and is a little vulnerable just in case stocks come off. So I think we need to be careful of that.
Okay, thank you. Roger, one for you, because I think this is what you were, the point that you were trying to emphasize with your risk management strategy. Someone was saying, should I set a stop closer, should I put my stop losses closer if my leverage is high? I think that was the point that you were trying to get across, that you reduce leverage to have the stop in the right place.
Yeah, again, it comes down to why am I in that trade? What am I trying to achieve out of that trade? And if the obvious stop loss for you becomes too expensive, then you don't move your stop loss up, you reduce your capital that's invested in the marketplace. Because the key thing here is you have the information there in front of you from charts of the history of that asset class that you're involved in, whether it be currencies or gold or whatever. And you need to use all the information that's available to you. And if there's no, let's say you're long and there's no other clear support line for 100 points, as we gave in our example, but that becomes too expensive for you. If you were to raise your stop loss closer to where your position is, yes, it would be a cheaper cut, but when the market moves in your favour, you may no longer be long of that. And let's say for the sake of losing £500, you got stopped out, and you've missed out on the opportunity of maybe making £2 grand by staying in the position, but with a smaller amount of risk in the marketplace. It's not a weakness. I think some people feel I need to have more size in it. It's not a weakness. Tailor your risk according to your conviction, market conditions, and all the other pieces of information that you have around you.
Thank you very much. Question for you, Maurice. If most major currencies increase QE, what are your thoughts on what currencies would do? As in, would they strengthen or they decrease? Are they being rewarded for doing more stimulus, or is it the opposite? Maurice?
Yeah, I think. Sorry, Chris. I think the market is a little more sensitive to this now. I think the ECB is probably the central bank that's closest to doing any more because of the deflation problems they can see in the EU. And I think what we saw last time when the guard was very dovish, the euro actually went up, which is unusual because usually when you get more stimulus, they buy bonds, interest rates go down, the differentials shift, and we get the currency weaken. That's not necessarily the case. We're at zero bound on many things, so interest rates are probably not going to move. So the only tool left is QE, and QE is actually seen to be pretty useless. So it's going to be interesting to see what happens if they do anything else. Personally, I think QE would probably see the euro weaken. If the Fed did more QE, I think that would weaken the dollar as well now. I do think what was going on before is that we saw countries rewarded for doing more fiscal stimulus, and that's what comes from the government. So we saw sterling rally when Sunak did more. We saw the euro rally when Germany's decided to start spending. So I think the upside for the markets is on fiscal stimulus, but probably still down on monetary stimulus, if that makes sense.
No, thank you very much. Question maybe for you, Maurice. Will things like Bitcoin potentially become more important in these times where the market is flooded with so much QE?
I do think that's a possibility. It's not a market I would want to trade yet until it's fully regulated and I know that no one can get hold of my Bitcoins or whatever they may be. I don't want to really take that risk. There's been too many hacks into that sort of stuff. But as far as that sort of digital currency structure goes, I do think it is something for the future. But until it becomes more regulated and central banks get behind it, then it's not for me. And I don't have a view on those digital currencies, but I do think at some point in the future, they are going to be possibly even dominant. But what happens between now and then is anybody's business, and they are extremely high risk.
Thank you very much. Maybe we'll use this as the last question, unless somebody else has got one wants to put one on the chat, just for the last couple of minutes. If a 4-hour chart on your Bollinger Bands shows one thing and the daily the other, what are your thoughts on how you approach that, Richard?
Oh, great question. I would say that the daily chart would tend to react slower than the 4-hourly chart. So the first signal will always come from the shorter term chart, and then you'd look for that to filter through to the daily perspective. I think it's very unusual that they would completely conflict, but if they do, then I would tend to favour the longer term structure, so the daily chart and that setup, because it's more significant in terms of price movement. But then I would also use, if I was sort of structuring the trade around the daily chart, the longer term perspective, I would then use the shorter term view to highlight the closer stop levels or trigger points that would make me rethink that structure within the daily chart. So effectively it would be a combination of the two, but it would be the daily chart that would be more dominant within the new signal. So it would be that one that I would tend to follow more, but watch the shorter term basis very closely for follow through.
All right, thank you very much, Richard. Roger, I think we'll finish with 2 questions for you. So for an intraday trader, somebody was asking how many trades is too many for a day? More than 4?
Well,
it's a psychology thing, I thought. That's why it was perfect for you.
Yeah, absolutely. I think some of it is down to momentum. You know, I was always a great believer that, you know, when you've got the ball, for want of an analogy, when you've got the ball and you're playing well with it, you've got to score as many goals as you can when you've got that ball, when you're on song, when people are running off the ball for you, and you're hitting the back of the net. And in that respect, what is that number of trades? Well, it's to the time where either fatigue comes in or you feel things beginning to run away from you a little bit. And again, I think that is a very key point in the psychological side of it, is being honest enough to walk away and say, do you know what? Not quite seeing it as clearly as I was 2 hours ago. Let's pack up shop. Let's take my money and run. And similarly, if your first few trades are not quite right, it's not necessarily always because you've got wrong ideas. Mo certainly mentioned a great word, timing. Your timing may just be wrong. And that takes, years and years of practice. So, having, again, the ability to say, do you know what, this is not quite for me today. I've lost a few £100 or whatever that number may be. I don't have to be sitting in front of my screens all day long to make money. Let's walk away from it now. So I don't think there's a defined number. I think individually you'll feel, run with it. If you're running with the ball and you've got it and you're seeing things very, very clearly, keep running with it. But be very, very smart when it starts going wrong. As I said, it's nothing to do with bravado, who makes the most money. You'll have your own expectations, yourself when you start each day or each week or each month, depending on how you kind of look at things.
Okay, thank you very much. Oh, go on. Sorry, Morris, is that you?
Yeah, sorry, it's me, Chris, Richard.
Oh, sorry, Richard.
I think that I agree everything with what Roger said. It also comes down to that discipline aspect that I was talking about in terms of, I was talking about in technical analysis, but it's actually having discipline that, if you feel that you're trading, you're not seeing the market quite how you should be, it's not being as profitable as it could be, then it's the discipline of actually taking a step back and reassessing. And then looking at things, and once things then sort of fall into line, then you come back with fresher eyes, and you can then sort of re-establish your consistent trading approach, and that discipline will naturally follow.
I think it's a great subject that you'd love to sit for an hour in a room of 15, 20 people. Well, we can only do it with 6 at the moment, but sometimes you could be, everyone has their own trading style, and I think what we'll look to do is to make that as flexible as we can over the next few weeks. But your style may not work on that given day, so don't try and flog a dead horse. If you're a range trader and we're going in straight lines, it's not going to work for you. And that means some days you may actually not even turn your system on because you read the headlines and you think this is not going to be a day for me. Don't go chasing the market, so it's important you just take all that into consideration before you start pressing buttons.
Right, and we're going to finish with one last question, because I think it's an important point that you were trying to emphasize with the strength of opinion. Somebody was asking, what percentage of risk would you trade with? And that's sort of the point you were trying to get across with that risk barometer, wasn't it?
Yeah, I mean, these are great questions in the first session, because we will be leading on to, those kind of answers. Again, a little bit, if you are a smash and grab trader, I think it builds with your experience. Jumping in at the deep end when you've got little experience, or you're trading a brand new asset class or currency pair, is probably not the smartest thing to do. So, for me, it's build your risk. I always say, win the license to be able to trade again tomorrow. And if you go in all guns blazing when you're not experienced enough, it can be tricky. So, for those that are new into this, feel your way into the marketplaces. You'll find what that level is yourself. The other thing as well, we will talk about, running portfolios, running multiple positions in the marketplace. That's when clearly people get more and more experience. But if you're going in there and you've got one position at a time, I would say it's something that grows with you with experience and confidence in the marketplace. You know, you'll find that level maximum, if it's a very, very tight stop loss, as we said in our example, could be your full 100%. You know, it really is tailor it according to the situation and your view and your strength of opinion.
Right, excellent. So we'll leave it there. Thank you to the mentors for your presentation tonight. Thank you for everyone that attended. We appreciate your time. We are back at the same time next week, and we hope to see you all then. All right. Have a great trading week ahead. All the best.